If you had $1,000 sitting in your account right now, would you actually know what to do with it? And I mean really know. Not guess, not hope, not throw it into some random stock because somebody on social media said it was going to the moon. Because that's what most people do. They either spend it, leave it sitting in cash, or gamble it trying to get rich fast. But what if I told you that your first $1,000 is way more important than most people realize? Not because it's going to make you rich overnight, but because it can completely change the way you think about money, investing, and wealth for the rest of your life. Welcome to the Money Teacher Pro, where money finally makes sense. In this video, I'm going to show you exactly how I would invest $1,000 today if I were starting from scratch. This is going to be simple, practical, beginner-friendly, and built for the real world. No hype, no get-rich-quick nonsense, no fake turn $1,000 into $1 million by next Tuesday garbage. Just a smart, realistic strategy that can help you build the foundation for real long-term wealth. Before we even talk about what I would buy, we need to talk about something even more important. How you think about that first $1,000. Because most people look at $1,000 and think, that's not enough to matter. And that exact mindset is one of the biggest reasons people never build wealth in the first place. They think they need $10,000 to start, or $20,000, or they think, I'll start investing when I make more money. But the truth is, wealth usually does not begin with a huge amount of money. It begins with behavior. It begins with consistency. It begins with the decision to stop being a spectator and start being a participant. Your first $1,000 is not about becoming rich overnight. It's about building a system. It's about proving to yourself that you can save money, keep money, and then put that money to work. It's about changing your identity from someone who only earns and spends into someone who earns, saves, and invests. And that mental shift is huge. Because once your money is invested, you start thinking differently. You stop asking, what can I buy with this? And you start asking, what can this become in 5 years, in 10 years, in 20 years? That is the mindset of an investor. And this matters even more because doing nothing with your money isn't neutral. A lot of people think cash is safe because the number in the bank doesn't move. But inflation slowly reduces what that money can buy over time, which means cash that sits too long actually loses purchasing power. So the first lesson of this video is simple. $1,000 may not feel life-changing today, but the habits you build with that $1,000 absolutely can be. Now, before I tell you where I would invest the money, we need to set a few ground rules, because the right investment strategy depends on your financial situation. Rule number 1, you should already have at least a basic emergency fund. That does not mean you need to be perfect. It doesn't mean you need $50,000 sitting in cash, but you should have some money set aside for unexpected expenses. Because if your car breaks down, your rent goes up, your laptop dies, or you suddenly need cash, the last thing you want is to be forced to sell investments at the wrong time. Rule number 2, if you have high-interest credit card debt, that should probably be your first priority. Why? Because if your debt is costing you 20%, 25%, even 30% interest, that's basically a financial emergency. And no normal long-term investment is going to reliably outperform that. So if your situation is no emergency fund, lots of high-interest debt, and no financial cushion, then the smartest move is not to rush into investing just because it sounds exciting. The smartest move is to stabilize your foundation first. Because investing works best when you can actually stay invested. A broad ETF gives you exposure to the overall market rather than one single bet. That broad passive approach is one reason many investors start with index-based funds tracking something like the S&P 500. Historically, broad market indexes like the S&P 500 have produced roughly around 8% to 10% annual returns over long periods, although of course returns vary and nothing is guaranteed. And what I like about that approach is this. You do not need to pretend you're smarter than the market. You do not need to stare at charts all day. You do not need to chase headlines. You do not need to predict which stock is going to double next month. You simply buy a high-quality, diversified fund and let time, compounding, and consistency do the work. This is also a very good approach psychologically, because beginners often make the mistake of thinking investing has to feel exciting. But boring is good. Boring usually means disciplined. Boring usually means repeatable. Boring usually means you're not constantly doing something stupid with your money. So if I had $1,000, around $700 would go into a broad ETF, something like an S&P 500 ETF or a total market ETF. That is the core. That is the foundation. That is the part of the portfolio that says, I want to own great businesses over the long term without making my life complicated. Next, I would take about $200 to $300 and put it into something that has a little more growth potential. This could be a growth-focused ETF, maybe one with more exposure to technology, innovation, or faster-growing companies. And the reason I would do this is because if you're younger, your biggest advantage is time. Time gives you flexibility. Time gives you room to recover from mistakes. Time gives compound growth more years to work. So while I would not make my whole strategy aggressive, I do think it makes sense to have a smaller growth allocation. Why not just keep everything in the broad ETF? You absolutely can. That is still a great strategy. But some people like having a slightly more aggressive piece because it can improve long-term upside and make them feel more engaged with the process. The important thing is this: more growth does not mean reckless. It does not mean meme stocks. It does not mean options. It does not mean buying the most hyped thing you saw online 5 minutes ago. It means slightly more aggressive but still intelligent. The key word is quality. So now the portfolio starts to make sense. Around 70% in broad market stability and around 20% to 30% in higher growth exposure. That gives you a strong base and a little extra upside without turning the whole thing into a casino. Now for the final piece, and this is optional. If I wanted to, I might take around $100 and put it into a higher risk, higher upside category. This could be an individual stock that I really understand, or a small crypto allocation. But let me be extremely clear here. This is not the foundation. This is the side piece. This is the learning piece. This is the I want a little extra upside and I'm willing to accept more volatility piece. And this is where so many people mess up. They hear one success story. One guy turned $1,000 into $10,000. One coin went up 800%. One stock doubled in 6 months. And suddenly they think the smartest thing to do is put everything into the highest risk bet they can find. That is not investing. That is hoping. Could it work sometimes? Sure. But over time, that behavior destroys more portfolios than it builds. So if I included a riskier slice, I would cap it at something small enough that if it goes badly, it does not ruin the whole plan. That way, I get the upside of learning and experimenting without sacrificing the long-term structure of the portfolio. In other words, I want my first $1,000 to teach me discipline, not addiction. Now here's the part that most people underestimate: the psychology of investing. Because investing is not just about what you buy, it's about how you behave after you buy it. This is where beginners really find out who they are. It's easy to say, I'm a long-term investor, when your money is sitting in cash and nothing is happening. It's a lot harder to say that when the market drops and your portfolio is suddenly down 10%, 15%, maybe more. That's when emotions show up: fear, regret, doubt, panic. And this is why the first $1,000 matters so much. Because it teaches you how to experience market swings while the stakes are still small. It teaches you that volatility is normal. It teaches you that seeing red on the screen does not mean the world is ending. It teaches you patience. One of the most valuable shifts that happens when you invest is that you stop thinking like a pure consumer and start thinking like an owner. That idea is explicitly emphasized in one of the scripts you uploaded. And that's powerful, because owners think long-term. Owners understand that good assets move up and down in the short term, but what matters is what they become over years, not days. This is also why I prefer a structured approach for beginners. If most of your money is in broad ETFs, it becomes much easier to stay calm because you know you are not depending on one random stock to save your future. So yes, strategy matters, but emotional control matters just as much. If you cannot stay calm, you will sabotage even a good plan. If you can stay consistent, even a simple plan can become very powerful. And that brings us to the biggest point in this entire video: consistency. Because let's be honest, $1,000 by itself is not going to make you financially free. Even if you get a great return, it's still just the beginning. What builds wealth is not one perfect investment. What builds wealth is repeatedly investing over time, month after month, year after year. Bull market, bear market, good headlines, bad headlines, you keep going. And this is where compounding starts to get really interesting. Money that stays invested has the chance to earn returns. Those returns can then earn returns. And over long periods of time, that snowball effect becomes enormous. That does not happen because of magic. It happens because of time, patience, and consistency. So if I had $1,000 today, I would not be asking, how do I turn this into $100,000 as fast as possible? I would be asking, how do I use this first $1,000 to build a system I can repeat for the next 10 years? That is the question that actually creates wealth. So let's put the full strategy together. If I had $1,000 today and I wanted to invest it wisely as a beginner, here's exactly how I'd think about it. First, make sure my foundation is solid. That means at least a basic emergency cushion and no dangerous high-interest debt. Then I'd put around $700 into a broad ETF, something diversified, simple, and proven over the long term. Then I'd put around $200 to $300 into a growth-focused ETF, or a slightly more aggressive but still high-quality investment. And if I wanted a little more upside and education, I might take around $100 and place it into a higher risk category like an individual stock or a small crypto position. But only if I fully understand that this is the risk slice, not the core strategy. And then the most important part, I would keep investing after that. Because this is not about making one move. It's about creating momentum. The first $1,000 is important not because it finishes the job, but because it starts the machine. If this video helped you, subscribe for more simple investing and personal finance content. And I want to hear from you in the comments. If you had $1,000 to invest today, how would you split it up? Would you go all in on ETFs? Would you add some growth? Would you take a small risk on a stock or crypto? Drop your answer below. And remember, you do not need to be perfect to start.